US stocks stabilise after yesterday's tech rout. Attention now turns to tomorrow's Federal Open Markets Committee decision, which could see US interest rates on hold. Meanwhile, Australia's inflation today is expected to give the Reserve Bank of Australia a green light to cut in February. That's coming up in our 5 Things in 5 minutes. And then in today's bonus deep dive interview, ANZ Economist Arindam Chakraborty says the new special economic zone between Singapore and Malaysia will present opportunities for both economies.
This provides Singapore with a larger supply of factors of production, including both land and labor. And particularly, Johor has proven to be an attractive location for tech giants with over 50 data centers in the state.
But first, in 5 and 5 with ANZ, US stock markets stabilised overnight after yesterday's AI-related tech rout. At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.5%, while the tech-heavy Nasdaq was up 1.2%. Nvidia was up 2.2% after its 17% plunge yesterday. Market attention now turns to the Fed with its first meeting of the year. ANZ head of G3 Economics, Brian Martin, expects it to hold interest rates due to strong growth, low unemployment, sticky core inflation, and policy uncertainty around tariffs.
The most interesting question for us, though, is whether or not the rate hold decision that we expect in January is a skip or if it's the beginning of a more extended pause. And we're going to have to wait to see the incoming data over the next couple of months in order to be able to determine that. There will be 2 more labour market reports, 2 more CPI reports, and indeed 2 more PCE reports before the FOMC meets in March.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was up 0.6% as the yields on US treasuries rose between 2 and 5 basis points. The Aussie dollar was trading down 0.7% at 62.44 US cents, while the Kiwi was down 0.6% at 56.59 US cents. Number 2, Australia's headline inflation rate is expected by ANZ Research to have fallen to 2.4% in the fourth quarter from 2.8% in the third quarter, with the markets expecting around 2.6%. ANZ senior economist Catherine Birch says the number is being pushed down by temporary cost of living support, meaning the focus for the RBA should be on core measures.
We're expecting that trimmed mean or underlying inflation will slow to about 0.5% over the quarter in Q4. Now, that would be the lowest quarterly result since mid-2021, and it would see the annual rate actually decline to 3.2%. Critically, this would be below the RBA's forecast of 3.4%. And so we think that that will be enough for the RBA to cut the cash rate by 25 basis points at its February meeting.
Number 3, Catherine says there is room for core inflation to print above ANZ Research's forecast and for the RBA to still be expected to cut rates next month.
If we saw a 0.7%, that would still mean that the 6-month annualised rate for trimmed mean inflation, so the pulse in underlying inflation, would still be sitting inside the top of the RBA's 2 to 3% target band. So, look, we do think that it looks pretty likely that the RBA will be cutting the cash rate in February. If we got, say, a 0.8% over the quarter, then we might have to think again. But the details are going to be really important as well. So, for example, we're not only expecting that trimmed mean inflation falls to 3.2% over the year, we think that services inflation will fall by 0.5 percentage point to 4.1% over the year as well. Now, that would be the lowest again since mid-2022, and that is the area of inflation that the RBA has been more worried about, that services side.
Number 4, ahead of the inflation data, NAB's business survey showed labour cost growth easing in December. ANZ economist Maddie Dunk says while on its own that would be welcomed by the RBA, other cost indicators rose.
In terms of the other cost growth, you saw a bit of a mixed message. So purchase costs were up, for example, retail costs also up. And if you combine those price and cost growth measures into an indicator that gives us a gauge for what might happen with inflation, that's sitting just between 2 and 3% at the moment. So previously it was at the bottom of that 2 to 3% band. We've seen it tick up slightly in the December data.
Number 5, overall business conditions improved slightly in December, although Maddie says the series has been up and down recently.
We are seeing a bit of volatility flowing through. So there was quite a weak report in November. We've seen this rebound in December. But all in all, the trend in business conditions is pointing one way, and that's downwards. And you're seeing that business conditions now are just below their long-run average.
Matty Dunk there. Now, in today's deep dive interview, ANZ Economist Arindam Chakraborty analyses the economic opportunities on offer from the new special economic zone between Singapore and its neighbouring Malaysian state.
Johor is a state of Malaysia in the south of the Malay Peninsula, and the SEZ is a part of Johor, and it spans an area of over 3,500 square kilometers, which is over 4 times the size of Singapore. And this area is actually further subdivided into 9 flagship subzones, and each subzone has been assigned specific industries.
And what are the main goals then of the special economic zone? Is it just Singapore investment into Johor or the other way around?
The main objective of the SEZ is to enhance the value proposition of the region, and this will be done by firstly enabling freer movement of goods and people between Johor and Singapore, and secondly by strengthening the business ecosystem within the SEZ such that it can attract more capital in specific industries. One thing that I think needs to be emphasized is that the SEZ does not intend to solely attract investments from Singapore. Rather, policymakers of both nations will work together to attract new investment projects globally. The aim is to establish 50 high-value projects and create 20,000 skilled jobs in the SEZ within 5 years of inception.
So how will they attract that investment? What type of incentives are on offer under the SEZ?
Probably the most important aspect of the SEZ would be improved connectivity between Johor and Singapore. The Johor-Singapore border crossing is one of the busiest in the world, with approximately 350,000 people crossing it daily, and mainly by road. A rapid transit system linking the two will be completed by 2026, which should help ease congestion and enhance labor mobility between Johor and Singapore. Secondly, there will be tax incentives for companies operating in advanced industries and also for knowledge workers. And finally, the Johor government will establish a one-stop center to facilitate investments, while the Singapore government will provide a platform to help Singaporean businesses invest in Johor.
So what's stopping each of these two regions offering this value proposition themselves? Like, what do they each bring to the table?
Johor is the second most densely populated state in Malaysia, with a labor force that comprises 2.1 million workers. Further, the median wage in Johor is lower than that of Singapore by a factor of 7. So this provides Singapore with a larger supply of factors of production, including both land and labor. And particularly, Johor has proven to be an attractive location for tech giants with over 50 data centers in the state. So going forward, the SEZ will help Singapore grow its digital capabilities, given the cost arbitrage in a variety of inputs, which are considerably more competitive in Johor. And also, Singapore has the most extensive free trade agreement network in the region, including bilateral ones with the US, European Union, and the UK. Given Malaysia does not possess these 3 bilateral FTAs, it can prove to be a significant advantage for both nations.
And I guess this is against that backdrop of a rise in friendshoring and a rise in those tariff and trade wars. So what type of corporates are they looking to attract through this zone?
Investments into Johor have actually been driven by the services sector in recent years, and specifically into technology services. And this is mainly due to the growing number of data centers in the state. Although investments in the manufacturing sector have also risen amid companies adopting the China Plus One strategy. So within the SEZ, certain specific sectors have been earmarked, such as manufacturing, logistics, digital industry, healthcare and education. And under manufacturing, there are certain sectors which have been marked as priority sectors like aerospace, medical devices, electrical and electronics, chemicals and pharmaceuticals.
Arindam Chakraborty there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, January the 29th. Catch you tomorrow with what Australia's inflation data should mean for the RBA next month. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.